I get asked these three key questions all the time. Stocks or bonds? Domestic U.S. stocks or international? Short duration bonds or longer duration? Some people would simply suggest sticking their finger in the air to see which direction the wind is blowing. But if you know me, you know I'm really big on a repeatable process. And that's why we have a process that enables us to address those three key questions. It's called growth cycle investing. So, what is growth cycle investing? Well, first, let's understand what the growth cycle is. There are 8 phases in the growth cycle grouped into 4 stages, as you can see in this graphic. Sometimes the economy is performing above the long-term trend, sometimes below, and as we move through the earlier late stages of each one, we can get an idea of where we are in the cycle. So our process determines where we are in the growth cycle, and where we are in the growth cycle determines how we address those 3 key questions. Right now, looking at a set of leading economic indicators, we're in phase 2 of the growth cycle. This means that short-term levels of economic activity are above the long-term trend. So what does this mean for our 3 key questions? Let's have a look. As to the stocks or bonds question, because the indicators say that we're in phase 2 of the economic growth cycle, this would tend to favor stocks over bonds. The second question is domestic stocks or international. As it turns out, there's no clear winner when we're in phase 2. So when we're building growth portfolios, we want to have a more balanced exposure to both domestic and international stocks. The next question involves shorter-term bonds versus longer-term bonds. You might be thinking, hey, the Fed looks to be raising interest rates, so the better bet would be short-term duration bonds. But the data from the growth cycle tells us that while there's a mild upward bias of interest rates in phase 2, it's not so strong that we want to be exclusively in short duration bonds right now. So we have a carefully allocated mix of both, and of course, we consider looking at the higher credit quality issuers. So what does all this mean? It means we're actively managing your money, taking into account a bunch of different factors based on where we are in the growth cycle today. And then we're using that information in a repeatable way for determining ultimately how to allocate your money and how to continuously address those 3 key questions for you.